It's my great pleasure to introduce our second distinguished speaker, David Murray, who is known to all of us, currently the chair of the Financial System Inquiry. David Murray has had a long and distinguished career in financial services and is well known as being a former CEO of the Commonwealth Bank and also his time as on the Future Fund. It's my great pleasure to introduce David Murray.
Thank you, David, and thank you for having me once again, and congratulations on the work that you're doing, and also for thinking to get those perspectives from John Howard, who's had such a long and distinguished term in public life. Today I want to talk about where we're at with our inquiry and what needs to be done, particularly to give you some reflections on our work post the release of the interim report and some other things we've been doing to broaden our base of information. As you know, the interim report covered three broad themes: growth and consolidation, the post-crisis regulatory response, and emerging trends in the system. And that covered 9 different perspectives around those three broad themes. Of course, the issue for us was, how do we sustain confidence in the system in a post-crisis world, and how do we do that, given that the post-crisis macro management has implications for what will emerge from here, and some of them, according to many commentators, are perhaps complex. Since we released the interim report, we have embarked on an extensive round of domestic and international consultations. We've held public forums in Perth, Brisbane, Melbourne and Sydney, and we've run a series of roundtables with industry participants and representative groups to get their reactions in the lead up to the second round of submissions. Internationally, we visited 30 different participants in the system: regulators, government agencies and market participants, and we learned an awful lot behind the scenes, how they managed through the crisis and how they developed policy from that point. We are still to travel to Asia shortly and see where Asia sits from a financial regulatory perspective, and also where they sit in relation to upcoming challenges in global markets. So these things will help shape our view for the final report, including the submissions that we're about to receive. So let me go through now what we've heard in doing all this. The first on challenges facing, the first issue relating to challenges facing global markets and implications for us is that there's a real sense of inevitability that the settings since the last crisis will produce some distortions in the system again. And so therefore there's some urgency for repairing systems. But the key theme was that the response since the crisis has been about more rules than principles. It seems to us that the political response to the crisis was simply to demand that this should never happen again and require regulatory agencies to build a formula to make sure it never happened again. There was no such thing as a cost-benefit analysis, no time for that, and so we have had a serious adjustment of the regulatory architecture in various countries governed by the culture, legal systems and political systems of those countries. For Australia, the reality is that we are not in a position to avoid those international regulatory standards. Those standards would be avoidable if we were an exporter of capital, but we have hardly ever been an exporter of capital and are not likely to become an exporter of capital. One of the reasons for this is it may not be in our interests, it may be in our best interest to remain an importer of capital because of the fundamental shape of our economy. That is, small population, large land endowment, and considerable upside to us from using foreign capital. So in those circumstances, we will remain influenced by the regulatory settings around the world, particularly in Europe and the United States, where capital markets are mostly conducted at this point, and particularly in relation to our in relation to the linkage between the fiscal management of the government and the condition of the financial system will remain influenced by our trade relationships with Asia, and in that sense we will remain conditioned by the fluctuations in the prices of commodities. In this regard, there is one piece of work that's not been done and isn't necessarily part of our remit, but we normally would expect that the financial system, in terms of one of its benefits, understands clearly the process of credit decisioning and the extension of credit. The value of that is that it puts price signals into the market and helps to drive an efficient economy. In doing so, people who extend credit are very skilled at understanding the leverage constraints on borrowers. But as far as I can determine, nobody in Australia has actually put out publicly and transparently the leverage constraints on aggregate governments in Australia. To have a country which is foreign capital dependent and commodity reliant would suggest to me as a lending banker that the constraint on government debt would be at about a similar style of leverage ratio to the constraint on a large mining company. And that is not a big leverage in a mining company is not significant compared with some other companies. This has not been done, and therefore the politics around debt are not embedded in any serious study of our circumstances. This then means that in the work of the financial system, where the ultimate backstop is government, there is no clear understanding that the fiscal position of the government and the prices in credit markets are directly related, and it creates an atmosphere in which the politicisation of banking and credit is far too easy, and that is not healthy and has never been healthy in other countries. We've looked at the role and nature of regulators in Australia, and we believe that strong, independent and accountable regulators are very important. And in the work we looked at offshore, the more common model is that regulators are publicly or industry funded, not government funded, but at the same time, other countries since the crisis have looked very strongly at both funding and the accountability process because they go together. Consumer outcomes have been a significant area of focus for us, and what we found is that there is no best practice model for advisor compensation and incentive alignment in the advice area, and one concern is that there's an excessive complexity surrounding the sale and provision of simple financial products. It's in this area that we have put down a principle in our interim report that puts us, it takes us a step further from Wallace, and that is that we believe that the combination of disclosure and financial literacy, whilst important, are not sufficient in our system. This is a very important issue for us. It means that we are trying to figure out where to place financial services in a spectrum of products and services in the economy. For example, there are some very simple products that are bought and sold in the system every day that are not the subject of heavy regulation, advice, or anything else. But we take very seriously the regulation of air safety. We take very seriously the regulation of pharmaceuticals, of medical services. And so there is a spectrum, and we're trying to figure out where financial services fit in that spectrum. Whilst it'd be simplistic to say people don't die from their financial services if they're badly designed, what's been very clear to us, particularly in the public forums we've held, is that the degree of suffering from people who do lose substantially is very significant. So from that perspective, we are trying to work out what should be the regulatory response. Now, we know that a regulatory arrangement in which the regulator is trying to second-guess every new product in the market does not work. It might be important in air safety, but it would not seem to be necessary for financial services. But there seems to be a need to have a system in which there is a much higher incentive on product providers and distributors in the system to build trust with their own customers. And that's why we're looking at the regulatory arrangements, the enforcement arrangements, the penalty arrangements much more closely, and we've looked at how these things operate outside Australia. On the question of the retirement, our greatest concern is that there's not really a shared purpose in Australia for the superannuation system. There were three purposes given for its establishment. One was that because there was an accord and wage constraint, there had to be a lot of people, a lot of workers in Australia who had no superannuation. Those people should have a superannuation benefit of some sort. So that was a way of moving from a wage benefit to a superannuation benefit, and so the superannuation guarantee started. Another reason given at that time was the ageing of the population would be very costly to the budget, and we should manage that. And another was that people should save more, Australia should have more savings. Now, if we look at each of those three original purposes or reasons that were given, I don't know if they were the purpose. On the first one, the amounts put aside were small, and it's unlikely that the people who had that new benefit will ever have sufficient of it to create a retirement income for a long, long time yet. On the second, the ageing of the population, the design of the system is such that the government still bears all the longevity risk in the system, and and people essentially save or accumulate up to the point of retirement, and then they still sit with the age pension as a free option. And so from that perspective, it looks more like a savings system. On the third, whether it's incremented savings in Australia or not is entirely unclear. It could be that if it weren't for the superannuation system, savings would have been generated in another form. So what we're looking for is views on whether this should be a savings accumulation system or a retirement income system, because once you determine the purpose, it makes a big difference to decisions you make from that point onward. And lastly, from the work we've done, we've learnt a lot about technology, but in the context that nobody ever really knows where technology is going to take us, only that it's important. And what's clear here is that the digital world is going to make very substantial changes to the financial system. It was made pretty clear to us in the United States that the Young Turks in Silicon Valley have as their immediate target, or first target, the financial services industry, which is completely understandable because the industry is about bookkeeping and message taking, which is the digital world's easiest target, I would have thought. And generally the model here has been one where systems which, or business models which started out to smooth the process of purchase and sale of goods through the internet soon added payment systems for further convenience in that trade, and from there we'll extend to inventory management systems for small business through more sophisticated payment systems for those businesses, and we'll then extend more closely to financial services, either through the establishment of funds where people can invest. They can become more problematic from a regulatory point of view, or from the use of data analytic techniques to do decisioning on consumer credit or small business credit aligned with the management of their systems. These technologies, in our view, will create substantial new competition in the financial sector and will put pressure on existing players to make some significant investments in technology that, frankly, they might have made years ago had they anticipated some of these developments. So these are important developments for us, and the value of the information we've learned from the first round of submissions has been very extensive, as has the other things that we've done. From here, we will get our next round of submissions by 26 August. We will then link up with our international advisory panel in Asia and check out views on the system in Asia. And then we will wrap up our report on time in November and report to the Treasurer. We essentially believe that the structure we have in Australia is reasonably straightforward. We've had few variations from the Wallace philosophy, but a lot has happened in the world and there is no room for complacency on the system. And let me give you, just to finish, a couple of reasons why that's the case. In Europe, there are ongoing stress tests in banks which will demonstrate that that system is far from repaired. There are ongoing difficulties in Europe with banks because the gap between their monetary system and fiscal system creates linkages between banks and governments which are much more difficult to resolve in Europe than they are to resolve elsewhere, and we're going to see more issues such as the one we saw recently in Portugal. These things are going to continue to keep political pressure on financial systems around the world. In addition to that, there are very large fines being levied on banks in the United States, which some people believe, including ex-regulators, are entirely unfair, but the US is the US, and so the idea of having a $10 billion fine is pretty attractive to the Justice Department over there, and they're going to try and beat some of their records that they've set already. And as those fines are levied, whether it be around the LIBOR issue or issues during the GFC, the public response will be to put more pressure on the political process for the financial system to clean up its act. In addition to that, the post-crisis monetary settings have distorted asset prices again. You might have seen the Governor's remarks from yesterday. And that is going to cause a correction at some point, which will put more political pressure on financial systems. So we're in this quandary where we created a fairly simple, straightforward structure. We didn't appear to be damaged by the crisis, but the guarantee that had to be put in place was unprecedented in Australia. We know we need to strengthen the system in some ways. We know we need to give consumers more recourse than they have now. But how do we keep balance? How do we do a cost-benefit analysis here that hasn't been done elsewhere, and balance out the temptation to regulate more in the face of these changes, but put in place a set of principles that make people give people ease of understanding of what's the right way to do things without over-regulating. And in that sense, a very common theme we struck offshore was when people found their regulatory systems wanting, the first thing they looked at was the Australian post-Wallace system. And most of what's been put in place is the Wallace system adjusted for politics, law, and a couple of other things in different countries. So that's a great thing to see, but we are challenged by this post-crisis environment to try and keep it simple, but strengthen it in some ways as well. Thanks very much.
Thank you, David. Just a couple of questions, if we can. There's any questions for David? Alex.
Just a question about the scope of the interim report, about whether it's the sort of totality of your thinking, or is it really just the things that you think you need extra information on, but you have broader thinking than is in the interim report?
Well, in the interim report, we did lay out some principles which will guide our thinking. We've picked up on a couple of new issues from our public forums, and the process of the report itself has caused some reaction, particularly where we challenged the banks on capital ratios and the superannuation system on fees. The industry reaction to those things has been very clear from the media, but I don't think we've. There is one lobby group that has proposed an entirely different system for finance in Australia, and that was the so-called Fisher model from the 1930s. So we've had a bit of a look at that. Difficult to see how you'd want to go first if you try that, and in a sense, the post-crisis response to banking systems has been to put many more layers of defence that model claims to have. So I don't think our scope's been broadened a lot since the interim report, but the interim report is meant to lay out options for dealing with things, including no change. So we leave things open to the second round of submissions before we get pretty serious in our own discussions.
One or two more questions.
Peter Carroll's my name. I'm an actuary. My question relates to what seems to me to be an oversight in the thinking of the people in the inquiry, in that they seem to be totally focused on banking and savings type activities. In the superannuation area, it's clear that the system we have is not going to achieve its objectives of getting people off the pension, even in the next generation or two. And in the insurance systems that we have, it seems that there's a huge degree of inefficiency with all sorts of stakeholders feeding off the system at the expense of consumers. Probably the only insurance industry that is actually efficient is the private health insurance industry, which returns about 80 or 90% of premiums to end users of it. And that is now going to be sucked into the APRA regulation system, which has failed with all the other insurance markets. So I'd be very interested in your comments.
Well, we have been made aware that the APRA regulation system works entirely differently for insurance and banking, and so we're curious about that. On the retirement income system, we have put a lot of effort into that system, but some aspects for it are not necessarily our concern because we're focused on the financial system. The issue for us is that is the way in which, given that it's growing in size, we're interested in the way superannuation funds allocate assets across the financial system, and whether the superannuation system represents effective competition to the banking industry in the provision of credit or the allocation to different types of instruments in the system. And in there we've indicated that there seems to be very heavy allocation to equities in the Australian system, that there seems to be a problem in the way that those allocations may not take into account the circumstances of different beneficiaries, the way in which that continuing allocation to equities may create sequencing risk for people close to retirement, and the fact that at retirement our financial system does not appear to create a range of products to help people during retirement. And those distortions can be created by the way in which trustees allocate assets. They can be created by the tax system, and we have mentioned that in the report. So whatever happens to the financial system, the way the superannuation system is conducted will be an important component. And so I think we have looked pretty closely at it. Solving it is not easy, but we are keen to come up with some suggestions in our annual report. And in the insurance industry, take your comments on board, but it has been raised with us.
Just in the interest of time, please thank David Murray for joining with us.
Thank you.